many years you've worked and you've accumulated money tax deferred in an IRA. And if it's not a Roth IRA, you will be required to take out RMD, required minimum distribution. Current law starts at 73.
That means that basically at the age you're accumulating wealth or trying to for retirement your whole life, and you hit the age 73, then you have to take out some of that retirement.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Mitchell Walk, managing partner here at Security Financial Management. Mitch, it's been a while, man.
It has been a while. It's good though. It's been very busy.
Mitch is our energizing bunny. He just is constantly on the go, constantly talking to clients, constantly analyzing the market. He keeps us all young, and for someone young, that means a lot.
Well, it's good, and things are good, and we stay on top of it here at SFM. And things are good. You know, we've good growth in the market in May and June.
Yeah,
so
exciting.
Just making sure the clients are allocated the way they need to be. And we're happy.
Absolutely.
Things are good right now.
Yeah. Which leads us to the question of the day. Today's question comes from Sam from Cocoa. Sam, what you got for us?
I'm slowly reaching the age of required minimum distributions, and I don't necessarily need the money, and I'd rather not pay the taxes. What would you suggest?
Thank you, Sam. Mitch, incite us, please.
Well, RMDs. First of all, what is an RMD? You know, you've heard that. Some people don't know what an RMD is. An RMD is, you know, for many years you've worked and you've accumulated money tax deferred in an IRA. And if it's not a Roth IRA, you will be required to take out a distribution. So RMD, required minimum distribution.
What age does that happen at?
That currently, under current law, starts at 73. It's moved up to 73 this year. So unless you're 73 this year, you won't have to start. Right.
If you're investing your whole life, right, and you have your
grows tax deferred, and eventually you'll have to pay the government some taxes and take your money out because you're required to do that.
Okay.
And it's currently age 73. There is talk, and I believe under current law, in 2030, it will go up to age 75. So your RMD won't start until you're age 75. So that's under current law, and as you know, anything can change.
So what that means that basically at the age you're accumulating wealth or trying to for retirement your whole life, and you hit the age 73, then you have to take out some of that retirement
You're
money.
required to. The government has a formula, and your custodian where your money is being held in that IRA, they will call you up and tell you, this is your required minimum distribution for the current year. And you have to take all of that out by the end of December 31st of the current year. So this year, it would be December 31st, 2025.
So someone in Sam's situation where it's time for them to take some of their retirement money that's been saved, but doesn't necessarily need the money right now, all right? So he's asking what does he do with it, and how can he?
Yeah, there's many options. There's quite a few options. But I also wanted to point out it's required at age 73. However, if you're retired and you need to live on some money and you want to take money out of your IRA, you can start actually at age 59 and a half without a penalty.
Oh, wow.
If you take it out prior to that, you'll pay the tax and a 10% penalty. But at age 59 and a half, you can take it out without that 10% penalty. But what are Sam's options? So Sam's options are, when he starts to take out the money, they have the calculation, and it doesn't all come out on the same day. Say Sam has to take out $12,000. Well, Sam said, I just need $1,000 a month, so you could start actually in January and take $1,000 a month out. As long as you take $12,000 out by December 31st, you've met that RMD requirement. But there is an option. Say Sam wants to give money to charity, and his retirement RMD is $12,000. Sam might say, well, I just want to give $6,000 to this charity and I want $6,000 for myself. They do a qualified distribution where it goes directly from the custodian right to a charity, and that portion goes to the charity. And since Sam didn't get the money himself, it went right to a charity. It's not taxed. There's no tax. He does not get a tax deduction for it going to the charity, but he does not pay ordinary income on that portion of his distribution. The other $6,000 he would take out normally, and he would pay ordinary income tax on that, whatever his tax bracket is. We recommend checking with their CPA, their accountant, to find out exactly what their tax situation is, how it will affect them. So we do recommend, because we're not giving tax advice, we do recommend that they do speak directly to their account to find out. And in some cases, people pay quarterly taxes, so they may not need to take money out when they take their RMD right away. We have some clients that say, just take out 15%, 20%, and then the custodian will take that tax out and pay it right to the IRS so the client doesn't get hit with taxes later on in the year. Again, we recommend you check with your accountant to find out what works best for you. Everybody's situation is different. However, if you are charitable and you don't want to pay taxes, you send it right to the charity. Now, you don't get a tax deduction, a charitable tax deduction, for sending it to the charity, but you also don't pay tax on that money.
Is there any situation where you could get both, like a deduction and?
You can't get both.
Can't get both.
It's a nice thought to try to double dip.
You double dipped the chip. Double dipped? What are you talking about? You dipped the chip, you took a bite, and you dipped again.
But the government said, we've been very nice. We've let you accumulate this money tax deferred for 20, 30 years, 40 years in some cases, a long, long time. One of the days, eventually you have to pay the piper. And in this case, they do give you one more bonus. I believe it's up to $100,000 can go to charity.
Okay.
Some people have $100,000, $120,000, $130,000 RMDs. They could send up to $100,000 to different charities. And it doesn't have to be to one charity. You can split it up, but it has to be a bona fide 501c3 charity.
Okay. And if he did all $12,000, then he wouldn't have got taxed on any of that.
He wouldn't have gotten taxed, and he did meet his RMD.
Okay.
And it's a problem if you don't take that money out and you do not meet your RMD. It's a 50% penalty. So he would probably have to pay about an additional $6,000 penalty because he didn't meet his RMD. Whatever portion they did not meet, they will be penalized on it. So check with your advisors. We're already coming up almost to July here, and we've got about 6 months left for the RMDs to be taken. And in most cases, offices, in our case, we start around late September, early October. If clients didn't need the money, we let it grow again, 6, 7 months tax deferred. But we try to make sure we start to get them set up by September, October to get that RMD out, because again, it is a very severe penalty if you do not take that money out.
Very cool.
As required by the IRS.
Very cool. If you want to talk to one of our advisors here at Security Financial Management, we're going to leave a link right here and in the description. Please give us a call. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.